Hi, this is John Licata with LicataLive, and this is Selina Kim. Selina?
Hey, I don't think it started yet. It says it
It
started.
says it's.
Oh, right here. Now we are.
Hey, I think we're live with LicataLive. It is Tuesday, a little after 11, and I'm John Licata with the Licata Group, and this is Selina Kim with Summit Mortgage. How you doing, Selina?
Morning, good. How are you doing?
Some stuff to talk about today?
Yes, we do. Well, some good news to start off the morning is that the mortgage rates are looking better. Uh,
They've gone a lot down the last 3 weeks.
yeah, so
How the heck is
conventional.
that happening?
So everyone is a little bit confused with how Fed rates and mortgage rates go. Of course, if you just want like the most simplified, I would say to pay close attention to like gas prices. If you want to know
The
how
gas
the
prices are coming down.
right, and that's why the mortgage rates are coming down. So that's why if you look at something that you see every day like gas prices, you can kind of relate to how the mortgage interest rates are going to go. So when we saw a large spike in gas prices, that's when we saw a large spike in interest rates for the mortgages.
But how does the Fed
Hmm.
increase the rate and the mortgage rates go down?
Right. So
Doesn't make
people,
sense. It's very confusing.
yeah, because people don't know what the difference a lot of the times what Fed rates are and what mortgage rates are influenced by. So the Fed rates are more um, rates that they're talking about are related to like credit cards, auto loans, more like portfolio loan types. And then the mortgage rates are more tied to mortgage backed security bonds, which are like what the feds will purchase to drive the economy, So when the inflation is high, then the mortgage rates increase because they're, trying to, the market's doing better, so they're trying to make more money off of that. But when inflation decreases, then we see mortgage rates decrease as well. So that's kind of like side by side. Fed rates confuse people, but that's talking about like other interest rates. So you're looking at like, your credit card interest rates or auto loans or, personal loans, that type of stuff. So when they go up, that's not as relevant to mortgage rates as inflation is. So,
So, what are you finding the sense of how people are feeling right now?
um,
Do you get a feel for that?
yeah, so I know a lot of people in the beginning, we've kind of crossed, I think, like a lot of different market patterns this year already. Where in the beginning of the year, it was like an inventory scare, like there was no houses,
There still
strong,
aren't many houses.
yeah, strong buyer pool, but then we started to see an increase in houses coming on the market, but then the interest rates took a spike, so that kind of pushed a lot of buyers to be intimidated of getting into it. But then now that it's normalizing and the rates are, getting a little lower, I think that buyers are thinking, okay, like this might be looking like the best time to get into it. So I don't know. I think we would strongly still encourage that it's a great time to buy because um, we're thinking that because these rates are lowering, that we're going to be driving into a recession, which can do the same effect it did that we saw kind of like in the beginning of the pandemic, where the house prices might go up. So, that might be worse for a buyer to really be waiting too long for because then you're going to be, again, running into the same issue where you have to maybe overbid on houses and stuff.
Selena, over the last,
Mm-hmm.
I just presented at a conference, and
Mm-hmm.
I did some back work on this. The last four recessions, going back to 1980,
Mm-hmm.
there have been six recessions,
Yeah.
and of four of the recessions, during the recession, home prices increased.
Right.
One, it dropped like 1.7%. It was almost negligible. And in 2007, the
Mm-hmm.
Great Recession,
Yeah.
it dropped demonstrably.
Right. And then the
But it
housing
was but
bubble.
it was a total that recession
Very different.
was really driven by lenders
Bad lending. Yeah.
bad lending and
Yes.
and and the masses getting screwed. I
Right.
mean, really, it was predatory lending. Totally
Mhm.
different than today.
Oh, very different.
Totally different.
Well, that's what drove the lending to be a lot more strict,
Yeah.
because I mean, we got to learn from our mistakes economically, and history will keep repeating. Like, there's always going to be ups and downs in the market, but the bigger things we can take away from it is how we can make it better the next time. And I think that's kind of why we drove a lot of the guidelines to be strict during the pandemic instead of less strict. It was a lot harder to get qualified during the pandemic, even when the rates were very low, because I think the banks and investors were trying to be smarter about it.
Well, the government
Hmm.
basically took the controls off. They
Hmm.
deregulated that industry
Right.
to the point where the industry was running amok.
Hmm.
And then after that, the government went back and started putting some brakes on and some
Right.
guardrails on. And those guardrails are there today. But, in 2007, I could get a loan if I needed $100,000. They would lend me $120,000. So what happened is,
Right.
people owned their house, had a mortgage above what the house was truly worth,
Exactly.
and then they walked away from it when it dropped, 30-40%.
Yeah. So
Excuse me.
yeah, I think that's also the difference too, is appreciation. The increase of appreciation back then was like way too dramatic to be sustainable, whereas right now it's still sustainable, and we still have a prediction that there will be appreciation, moving forward in most areas, but just not like what we saw in double digits, but probably in the lower singles, like 3.5% to maybe 5% in most areas. So that also helps with not being negative in your house, because you're selling a house way inflated or way appreciated and overpriced, and then when the market crashed, all of those values got lost and it was going into the negative, so people were not able to afford their homes in the most case. But here there's ways out of that. So
Well, everything, all the data that we see is about 30 to 45 days old.
hmm.
And so the market is moving still a little quicker, certainly quicker than 45 days.
Hmm.
But, the other thing is like I feel bad for the first time homeowners, first time home buyers,
Hmm.
the young professionals, the young families. Um, I saw these numbers. Rent
Ugh.
in the last 12 months
Uh-huh.
nationwide, rent went up 11% nationwide.
Mm.
In our region, which is the greater Washington area, the DMV,
Oh yeah.
18%.
18%. Yep.
That far exceeds almost anything else. So they don't have a chance. They're getting squeezed there, and then they're getting squeezed at the level of they want to buy a house. It's very competitive. They were trying. They'd make an offer, but 15 other people would make an offer. Um, what's going on with those folks? Like, what do they need to watch about
Yeah.
now? Because with today, there aren't 15, 20 offers going
Right.
on.
There
So they
honestly
have a
it's
better
more,
chance.
I think it's not funny, but the interesting part about rent versus buying right now, rent is becoming more competitive. I think the rent qualifications are almost harder to
Yeah.
meet than
It's
buyer
it's easier to get a
qualifications.
loan than it
Yeah.
is to pass a
Yeah,
renter.
because there's really not a lot of programs that will help a renter. Like, there's not going to be programs where they'll give you money, like a grant to put towards, a down payment or a security deposit or something like that. Whereas loan programs, first time home buyers have the opportunity to look for programs that offer grants and finance your down payment options, where you can not have to pull all that money out of your pocket at the closing table.
Well, and money is a big driver,
Hmm.
but in terms of to qualify for a loan, what is your credit rating need? What's the minimum
So
credit rating?
for
Just the
a
minimum.
minimum credit rating, you can be as low as like a 580 to get qualified for a loan. But of course, that comes with other factors. But for the first time home buyer program, the minimum qualification is 620.
So it's almost impossible to rent unless you're at a 600 credit rating.
Yeah, but then they look into it more too. Like they are looking at delinquencies more. They're looking at your judgments or liens if you have any from the past or collections accounts. And then also for renting, a lot of the places are doing background checks.
Yeah.
Things like I said, the qualifications for renting with it being 18% higher, it's just ridiculous. Like you are competing on what you're putting your rent in. So if something's listed to rent for 2,000, people are putting in higher.
And it's not regulated. It's a
Yeah,
private individual
exactly.
who owns that property.
Yeah, you don't get protection at
deciding
all.
of so you don't get any abatement. You don't get any credit.
Yeah.
The other thing that I found interesting is a what's known as a balanced market, which is good for the buyers and the sellers, right? Is 6 months of inventory. 6
Yes.
months of inventory is what they call a balanced market. In the nation, last month, there's across the nation averages 2.6 months of inventory.
Yeah.
Still
Very
far below the 6. And in the DMV, it's 1.3 months
So it's
of
even
inventory.
half that.
So it's still skewered to advantage seller. Although to the benefit of the buyer, if they do qualify and they do have some money to put down, it's not as competitive. You don't see as many offers. You still might see one good offer, right? You're not seeing as many non-contingent contracts.
Yeah, so it's not as intimidating for buyers anymore. Like it's not like so seller focused where like sellers could pretty much ask for anything and get it in the beginning when inventory was very
Almost anything.
Yeah, and anything.
Just throw it against the wall.
Yeah, they were doing it as is, but now there's a normalization where there's sellers that are willing to give some credits if they don't have everything in tip-top shape, or depending on what area they're in, it becomes a little less competitive. So they are offering credits, which is gonna be helpful for the buyer to save some money as well. And they are protecting the buyer a little bit more by doing like the inspections and things like that. Whereas people were just kind of walking into houses blind because you needed to.
On our recent, we've had a pretty good run. Now things are slowing down. It definitely is shifting, but I'm thinking of 2 recent where we brought buyers to a listing. Both of them. The one example is a financing. They're getting financing, so they have a financing contingency. It's not a cash offer.
Right.
They are getting a home inspection. They did, so that was accepted. Again, very normal. Financing contingency because the lender's involved.
Yep.
Home inspection, so there's a level of scrutiny. They're not going into it blind. And that one was slightly over list. It still paid a little premium above list price, not crazy, but a little bit above list. And then we just had one on a waterfront property, an expensive waterfront property. It was the listing started here, it lowered the price. Had been on the market for at least a month, a little bit more than a month, and the couple who are buying that house have to sell a home in Northern Virginia, which again is a great market.
Oh yeah, great.
So there's a home sale contingency. Now it's a tight one. I mean, they don't have months to sell it. They have 4 weeks to sell it, and there is a home inspection involved in it. So it will be a cash once they sell their home in Northern Virginia in the DC, right up close to DC. But they're also having a home inspection where 3 months ago, that would be unheard of. First of all, it would have sold at the higher point.
Mm-hmm. Yeah.
Second, there'd be so much competition, there was no home inspection.
Yeah, everybody was getting
And
rid of
third, it was
everything.
probably going to be a cash buyer on that.
Yeah.
So it has shifted. It's still the house is selling at a premium from what they bought it. They're certainly making the sellers are certainly making a nice profit on their initial purchase.
Mm-hmm.
But so it's sort of a win-win, sort of balanced, a little bit balanced, still advantage seller, but not quite as advantaged as it had been, not as near as
Right.
one
Well,
sided.
because the seller is still going to make the money. I think that's the bottom line. Is I think what the I think the seller is the most concerned about. Like, am I gonna, be giving all these credits or whatnot to lose money? But I don't see a lot of sellers losing money. Still, appraisals are still coming in pretty good. At even when they're going a little over to ask for a credit, appraisals are coming in. So because the values are there, I think it's still a great market for both sides. Because if you sell, you're still going to make your bottom line, or maybe more. And if you buy, you're buying at a good time where you'll still have appreciation, to look forward to.
So generally,
Mhm.
um, the market interest rates have come down the last 3 weeks. What was the high point?
It was like close to seven. It was like high sixes, seven, and now
And
we're at like the high fives.
high five, so it's dropped about a point.
Yeah.
Dropped about a point.
Mhm.
Are we expecting it's going to sort of settle in there? Or
Um,
what is the smart
so,
money betting on?
so I think the biggest question here is when we are really expecting like a recession to really surface, because
Well, we've just had two
yeah.
straight quarters of GDP being below, so
Right.
we
So
are in a
well, I don't
recession.
think we're completely in a recession yet because we still have the inflation pretty high compared to like a normal market. But I think when that happens, they're trying to drive it to be faster, which is why the feds are raising these rates on their interest higher, because I think that's indicating a recession to be driven sooner. So I think we should expect it to kind of balance out soon. I don't think we should expect a hike like we saw before. So if, like I said, if you're getting into buying, I think it's better now, because when the rates will drop more, then you have to battle the prices
Prices
going
will
up.
up.
So I think you want to definitely get in there when it's normalizing, so that you can still go in there with inspections and ask for some credit, or and know that the value is going to hold, versus going into a market where you have to go up in price and maybe come more out of your pocket.
Well, I know in the Fredericksburg Area Association of Realtors, I was traveling last week, but they sent out a report,
Mm-hmm.
and it had all the counties that are part of the association: Orange County, King George,
Mm.
Fredericksburg City, Spotsylvania, blah blah blah. And it was home appreciation by county was anywhere from, I think, 6 to 13%,
Mm-hmm.
including Stafford and all. So still, very advantaged
Yes.
to homeowners,
Right.
to homeowners.
Right. I mean, we were just talking about. I think we're trying to push the whole marry the house, date the rate type mindset. Because the house is the long term picture. The long term, like, you're gonna be there, you're investing in it. The rate can be short term. The rate you can change at any point in time when it gets better, because like we said, the history shows there's never just a period of time where it just stays the same forever. There's always an up and down. So if there's an up, there will be a down. So you can kind of look forward to refinancing, but at least you're putting money in your own asset instead of someone else's pocket.
Well, I know we've always consistently talked to our clients and say, hey, if you're in the house for 3 to 5 years, buy the house thinking 3 to 5 years. Now, yeah, 20 years ago, it was a 3 to 5 years people would live in the house. Um, since 2007, that's actually moved higher than that. But I think if you're buying and holding for that 3 to 5 years, you're always going to have a level of protection. But if you're buying today and expect you're going to sell 2 months from now, that's, you're at risk.
Oh yeah.
You're at risk.
Right.
And the other thing I think is funny, and then we'll start closing out, was you know, if I asked anyone listening on the call or who would watch us on YouTube and said, how many people pay for a mortgage? A lot of hands would go up. Most
Mhm.
people don't own their home. They buy a home, but the bank owns,
Yes.
has a mortgage on it. There are some people, of course, who don't have a mortgage.
Mhm.
And then you have people who are renting and
Right.
paying someone else's mortgage.
Exactly.
So if you're in a house, one way or another, you're paying for a mortgage.
Yeah, you are.
Whether you own the mortgage or someone else.
No, might as well
owns the
you
mortgage.
own it than somebody else, right? I mean.
I'd rather own my house.
Yeah,
At least
exactly.
build some equity.
Especially when rent will keep increasing, but mortgage can go the opposite way. Most likely, if you just refinance and get a lower rate, you can drop it. If you get more equity, you can drop mortgage insurance. That will also lower your mortgage. So there is a higher chance that your mortgage will get lower in the course of time, but there is almost a guarantee that your rent will increase. So.
I'm going to close with this. We are in the process of planning a financial meeting, a
Mhm.
financial seminar,
Nice.
not a real estate seminar, but a financial seminar
Mhm.
that we will invite anyone and everyone to. And it won't be just surrounding real estate. It'd be around what the heck is going on? What's going on? Are we in a recession? Are we not in a recession?
Mhm.
The definition, and we'll bring in some financial people along. So more to come on that in the coming weeks.
Yeah, it's
Anyone will be well. Obviously, we'll videotape it, but we will invite anyone and anyone that has an interest in learning more about that and bringing some experts in to.
Yeah,
to
great way to ask questions that people might have. Because I think finances mean a lot to everybody. So
For everybody.
might as well be educated with the experts instead of trying to look up stuff and try to understand everything that can be misunderstood. So.
Well, everybody has an opinion.
Right.
The realtor has an opinion, the lender has an opinion, the electrician has a opinion, the plumber, the carpenter, whatever. Everybody has an opinion, but not everyone is an expert. So the best thing we can do is listen to the experts and not necessarily the ones who aren't the experts.
Right.
Okay? Well, thank you. It's been great talking to you. Great to have you here. And I think that's it for LicataLive today. Thank you,
Have a good
and
day.
see you soon.